All right, I mentioned this is being recorded. At the beginning of all of these webinars, I talk about this time and time again. Watch this again. We've also added a ton new videos and webinars to the archive. So if you guys are premium members and stuff like that, make sure you check those out as well. You don't have to watch the same one on the Long Straddle, this low volatility one. Maybe watch one of the other ones, because I do have a tendency to sometimes talk about something I've forgotten in a previous one, okay? So, or talked about it in a previous one and I've forgotten to talk about it in this one. So make sure you watch the two different ones to get the full gist of it, I guess, maybe. And it will help make you remember it the second time through. Stefan, good to see you. All right, so let me go over a couple of things real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for about 25 years now. I actually started trading my own money in college with some money I had earned. And I was trying to get a psychology degree. Thought I wanted to be a psychologist. Decided, hey, I like this trading thing. Switched it over to finance. After graduating with a finance degree, moved to Chicago and started working as a runner. And then sold all my stocks, moved into the pits and started trading. One thing I did say, though, when I was on the floor is my psychology degree probably suited me better for trading than even my financial degree. So in that time, I've traded everything from stocks, financial futures, commodity futures, and currencies, and options on all of these products in just about all market conditions. And finally, let's go over this disclaimer. Any opinions, news, research, and analysis or other information contained in this webinar is for general commentary. It does not constitute investment advice. Also, please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, you guys can follow me on Twitter at Wolfman's blog. It would have maybe helped you out this week with the crazy moves that we have had. And I talked about this straddle that I put on earlier on in the week in SPY ahead of the big market move. So make sure you guys are watching those. All right. Like we said, this is on the Long Straddle, and we're going to be talking about how to set this up properly. Yes, you can go online and figure out how to do a Long Straddle. It's basically buying the two at the money strikes, right? A call and a put at the money at the same strike. That's it. You're on your way. Well, had you set this up incorrectly or started like maybe doing a Long Straddle right now, you could be putting yourself in a very perilous position. There are certain times that we can implement this strategy. And earlier on this week, we had a great opportunity for this. And in the daily market commentaries, I was talking about this. One real quick, thank God you're here. If there were ever a week that we needed you, this is the week. Thank you very much. Hi, my friend. How you doing, Ted? Appreciate the kind words. All right, so straddle, like these are the kind of things, like when the market isn't really doing anything, these are the times where we want to put in the Long Straddle for the outpaced move that it comes into fruition. So like I mentioned, you can go online and find, you buy the at the money put and the at the money call. It's that easy. One thing you do want to make sure you try to do is create a delta neutral strategy. And we'll talk about that a little bit more as we start pulling up the platform. But if we were going to look at it on the Analyze tab, you would see it as kind of like this, where you know what your max loss is, but your max profit is unlimited. Had I been able to squeeze this down, you would be able to see that to the upside, it is unlimited. So that's what it looks like on the Analyze tab. All right, so the essentials to success, picking the right environment. This is the most important aspect of the straddle, is the environment, because the environment really affects the straddle dramatically. One thing we learned in a couple of the previous webinars here just recently is about the volatility. Volatility is going to affect those options that are closest to the money than any other option. So we're dealing with a lot of movement by doing this at the money straddle. The right environment here, though, is for stocks. When we're trading stocks, we need an implied volatility percent that is below 50. And for ETFs, an implied volatility percent that's below 30. Also, to keep in mind with this, when we're getting into this, we're thinking, okay, Wolfman said environment below 50 for stocks and for ETFs below 30. We also want the expectations of volatility expanding Okay, so that's part of this environment. That's part of our thesis when we're building out this strategy. We might not have a directional assumption. We think it's going to move really fast in one direction or the other, but we don't really know which one. We also need to have that low implied volatility, because as volatility expands, then it helps us. Because remember, we have a bunch of things going on here. We have theta decay going on. So, sorry, I didn't want Theo. I went delta theta. So we have theta decay going on. So 71 cents a day coming out of this Amazon trade, which seems like a lot, but Amazon's a big dog. So let's look at something else like normal Cummings. So that's pretty wide. Let me find a note. Let me find a good example. Sorry, you guys. That's something realistic. ADP. All right, whatever. So what we were talking about with this environment is the volatility. And as you can see, volatility to these ones that are closest to at the money, this number is a lot bigger than the ones that's further away, right? So volatility, when we're buying this strategy, we want to be buying this number when the volatility is pretty low. Because when that expands, then that's when we get paid. Even if the market doesn't move, we could look at the theoretical. Maybe that was a Freudian slip where we zero out everything. So if we bought this straddle, you can see the prices. Let's just say, you did the 135. So let's just keep an eye on the 135s. You can see mid-market is 951. So if we just had the stock not even move, but volatility start to expand on us, watch this number right off to the side here. This is the thing that's going to tell us what happens to our premium as volatility increases. So you can see dramatically with a 4% increase, you have a nice big return just on that alone. And we can see this happen in SPY earlier on this week. When you guys were watching the daily market commentaries, you saw me put on that SPY trade when implied volatility percent was around 23. It's 41 now. So it's increased by about 17 percentage points. All right. So, you might be like, hey, Wolfman, that's a big move. Well, hey, listen, we just saw the VIX go from basically, what was it? 13, 14 at the beginning of the week to 25, something like that today. All right. So that's a big move. So you can easily see when we have a straddle put on, we want the volatility to expand. We also want an outpaced move that will definitely be in our favor. But the big thing is we want this volatility to be really low. And when I'm talking about implied volatility percent, what we're looking at is this little line here. This is implied volatility. And as you can see, I have it over here on the watch list, implied volatility percent. And there's quite a few at 100. That just means that we are at the highest volatility we've seen all year. Okay. So it can continue to go higher. It'll still be 100. But the idea is when volatility is this high, that's when we'd want to be selling it. And when it's really low, like down here, then we would want to be buying it, right? So we want to buy volatility when it's really low so that we catch that expanding implied volatility, all right, which is what I did in SPY earlier on this week with this particular strategy. I was talking about this market is really juking back and forth here and feels like we are ready for a big move happening. I don't know if it's going to go up or down, but I want to put on a straddle because my volatility is really low. It's in the lower, it's below it. 30% for an ETF or an index. So that's the opportunity to buy it. Look, it's expanded from an implied volatility percent of 23 to 46 now. All right. So a huge expansion in volatility. Yes, the market move helped me in my directional move as well on this straddle, but the volatility when we're doing this straddle needs to be low. Okay, so make sure you get that. And if you get that outpaced move, especially to the downside, you're going to see that volatility expand for you. All right. All right, so that's picking the right environment. Low implied volatility percent for a stock under 50, for an ETF under 30. And we would like the expectation of expansion and volatility going forward. Now, picking the right underlying. With this, what we're talking about is a tight bid ask. So for a stock that is over $100, we just basically move the decimal place 3 ticks to the left. So 27 cents is how wide our market should be on the stocks, or on the, option montage. This is the option montage, all this stuff. Everything you see on here is a montage. So in the option montage, the closest to the expiration month with about 30 some odd days to go. You could even look at these, but nobody's really trading those anymore. But this monthly, you want to go to the monthly that is the spot month where most people are trading, and that's usually right around 35 days to expiration. And we look at that, so we take the decimal place 3 ticks to the left. That's how wide our bid ask should be on these just out of the money options. Okay, so you can see that SPY is 10 cents wide, so that fits that rule. Something like let's look at another one that's under $100. Let's look at Coca-Cola. Anything under $100, we're looking at 10 cents wide. We want this option montage and the closest to expiration to be about 10 cents wide. We're going to probably be trading out here in January and December for this particular strategy. That theory of 10 cents wide won't necessarily always work on these further out. So look for that in here, the right underlying. If it's inside of 10 cents wide here, you're going to get good markets further out as well. They'll probably be in the weeds, but which means that they're just not showing their hand. But as soon as you start coming in to bid, they're going to get a little more aggressive as well. All right. And the reason why we want a tight bid ask here is because it shows us that there was a lot of volume and open interest going on in these contracts. You can see there's a lot of open interest, 40,000, 30,000, and a couple under contracts trading today alone. All right. So what happens is when there's this much open interest, there's a lot of eyeballs on this, right? There's a lot of people that have a vested interest in Coca-Cola. So what happens is they are, maybe coming in and offering 46s or 56s on this strike. Then somebody else comes in and goes, well, now I lost my offer. I'm going to go down to 55. And that's what happens when a lot of people are in there, is we're all biting to get our order up front. And that free market price discovery tightens those markets up really tight. Okay, so that's what we're looking for. A lot of participation. Something like Toyota Motors does not get, generally speaking, as of lately they have. But as you can see, generally speaking, not a lot of open interest or volume. Everybody's heard of Toyota, right? They've had a lot of volume trading probably in the stock. But the fact of the matter is, nobody's in here trading the options. So stay away from it. It's going to be very difficult to get in and get out. And if you had to give up like 25, 30 cents to get in, so I'm offering $2 now, or $2.10. Now I'm going to have to wait forever to get out just for a scratch, right? Because it's like 30 cents higher. Theta decay is only going to be a couple cents a day. If we look at theta, it's only 3 cents a day. So I'm going to be in this trade for almost, if nothing else changed, the market didn't move, volatility didn't change, and theta decay just started ticking away. It'd take me almost 10 days or so just to get to break even, right? Because that price decays very slowly. So it's going to be very difficult to get in and out of that strategy. So stay away from something like Toyota, where it has really wide markets. Stay in the ones where there's a lot of volume and open interest. All right. So that's picking the right underlying. Make sure there's a lot of volume and open interest. Picking the right duration. With this, what we want to do, because we're buying the options, we don't want theta decay. So you can see the closer we get to expiration, this theta decay on these close to at the money strikes is 7 cents a day. Now we go out 30 some days, it's 4 cents a day. We go out even further to January and it's only 2 cents a day. Well, since we're buying these options, we want to limit that theta decay. So if we're going to limit that theta decay, we need to go out further on the time horizon. And another beauty in this is we've limited our theta decay, which is limiting our money that we lose per day. But on top of that, it gives us a lot more time to be right, okay? If we get inside here, we got that theta component like eating away on us. We're a little panicky. We got to make this happen quickly, Whereas when we're out here, hey, it's life is a peach. We can let it ride for a while. We don't have to worry about that theta decay. The Coke is a 47% IV and not the time to buy, right? Yes, Coca-Cola is not the time to be buying. I mean, it's 47. If you expected volatility to expand, then yes, you could, because it's below my rule of below 50. But I would tell you, I'm agreeing with you, Bandu. We've had a couple of days of big moves here. I would maybe expect one more move down and then people start scooping this value. So I don't really expect to be this as a long-term bearish move. I think the economy is doing very well. It's more of the market, I think, right now is throwing a tantrum as a signal to the Fed to start slowing down on the interest rate increases. And I couldn't agree with them more. I think the Fed should take a breather. So anyway, that's just my soapbox. So you can see that we would want to get further out in time. So picking the right duration, get out there outside of about 45 days at least. So we're going to be looking at December and January. So we want to basically be outside of this way. You can see that these are the at the money strikes, and you can see the theta decay starts picking up the closer we get to expiration, just like that. We saw 7 cents here and 4 cents here, and then 2 cents out here. Okay. So you can see that it starts picking up quickly the closer we get to expiration, and we want to avoid that. So stay outside of at least 45 days to expiration. Okay. That's where we want to be, outside of that 45 days, because this will start eating away at our premiums very quickly. Okay. All right. Picking the right strikes. Really not a whole lot to see here, other than we want to make our strategy as close to delta neutral when we're doing this strategy as possible. And like I said, we're buying both of them. So when we're buying this option, we're buying 55 deltas here. Okay. So we bought this option. We're long 55 deltas. We buy this option. And because we're buying a negative delta, it's negative deltas. So 55 plus negative 44 gives us positive 11. So this strategy set up the way it is slightly bullish, okay, just due to the delta. And no, I would not be trading this strategy because it doesn't fit my rules of the tight bid ask. I'm just giving you an example here for purposes of giving you the delta, okay? But we would like to get this close to delta neutral as possible. That one is not going to give us that opportunity, but try to work on that, play around with it a little bit. For instance, and now when it was giving us a positive delta or a negative delta, depending on what strike location we pick, depending on your bearish or bullish assumption, maybe this is a pretty market neutral assumption with the expectation of a outpaced move. The reason why it's market neutral is we don't know which way it's going to go, right? We don't have a market assumption really. Now, if you did have a lean, like I feel like this market's due to pop, but I'm worried about the downside. Say for instance, today, I think you were going to put on this strategy today. I think the market's going to move higher or whatever, has low implied volatility, but I'm worried about the downside. You throw on the straddle, but you make the delta slightly positive because you're leaning towards that bullish move. Does that make sense for everybody? How I explained that? You're leaning towards that bullish move. So if you're leaning towards a bullish move, but you're not really sure, you think maybe it could really fall out of bed, then make your delta slightly positive. You'll still get your bang for your buck when the market falls out of bed, but you'll get paid off a little bit better if it moves a little bit better, quicker if it moves higher, if that makes sense. See a couple of questions. Trump said the same thing about the Fed when they were raising interest rates to pay for his tax cut. That's funny though, LOL. Well, it's true. If we have a lot of debt and interest rates start increasing, we have to pay off our own debt as a company or as all I can think of this company, as a government. That's a lot to pay towards interest, right? We'd rather just pay off the principal, just like us with our houses, right? We would like our houses to have as low an interest rate as possible because you're paying off principal, right? And when interest rates rise, you can't afford as big of a house. Okay, you might have been looking at a 2,000 square foot house, and now you're looking at a 2,000 square foot house, and now you're looking at a 1,500 square foot house, and your payment's the same. That might not be exact math, you guys. I'm just giving you the theoretical idea of that. All right, and knowing our exit strategy before entering the trade, write it down as well. All of this stuff, everyone, you go through your checklist, right environment, write all of this stuff down. What was my directional assumption, so that you guys can go back and look to see what you did right and what you did, or what went right and what went wrong. Hopefully you're doing everything right and everything wrong, or everything right according to my rules, and not doing things wrong. Follow these rules. Write down your exit strategy. My idea on the exit strategy, I'll show you here in a second. But basically, if ultimately we can get like a 50% increase in our premium, that is a home run on a straddle. Like, say for instance, 50% increase going from $10 to $15. I bought it at $10, now it's $15. That's a huge home run, you guys, on a straddle. And I'm not going to hold it much longer than probably 30%. And as a matter of fact, if you guys were watching the daily market commentaries, when I saw all of this happening this week, I was talking about, I was like, the way the market's moving, even though Monday was a holiday, the way the market snapped back at the end of the day, and then Tuesday we had the big move and snap back in a lot of markets, and then yesterday some follow through. But those couple of days where we were seeing the snapbacks, I was like, this feels like there's a lot of tension building up, and this battle is really in full throttle, I guess. And then it just felt like it was going to snap. And I said that in those daily market commentaries. And then later on that day, I decided to go out and buy this long straddle in SPY. So I bought the 287 straddle when it was trading right around there at 285, 287. And then it was 287 and change. And I bought it for 14.08. Okay. We got those big moves, right? I was able to get out today with the volatility expansion and everything else for $18.12. Now that is about a 30% increase in premium in 2 days. All right. And I'm not cherry picking this, you guys. I talked about this the day it happened, or the day I was thinking of it. And that's why it's so important, you guys, to watch these daily market commentaries, because I go through these progressions. Like in the webinars, it's theoretical, right? We're talking about if the setup happens. In the daily market commentaries, when I see that opportunity, I jump on it, okay? Just like I did here. So I was like, hey, I feel like volatility is ready to spike. VIX is moving higher. We're not seeing the volatility really show up in SPY right now. So it is the time to jump on there. And, sometimes you'd rather be lucky than good. This time I got lucky with the timing, but I increased my probabilities of success by setting the strategy up in an environment that was conducive to what I was looking for. So, I mean, you can't knock that, right? I mean, some people may be saying, hey, Wolfman, you're lucky. Well, yeah, I was lucky. I mean, it lasted 2 days, right? I'm not going to lie. And another thing, sorry, I'm jumping around a lot today. Sorry. Another thing is people talk about like the exit strategy, when to get out and stuff like that. I do give a lot of things like this, and you guys can write this down. If you're in the trade for 10 days and you're at a 10% increase in profit, then take that. 15 days, 15, 20, 20, 25 days, 30. And the reason why I go 30 is because you should be seeing that by that time, or it's not happening at all. So if you are, say, 9 days in this trade and you got a 10% profit, jump out of it. And in the daily market commentaries, I knew I was at a 30% increase in profit with less than 10 days. And I said, I'm pulling the trigger on this trade today because I can't beat this probability any better than I already have. So that's why I ended up getting out. And it was a 30% increase in profit, which is usually my target for a straddle anyway. It's hard to get. You'll never get the full premium in your straddle, you guys. The reason why is it would have to settle on the day 287 even. like close 287 even for me to get every single penny out of this trade. And with gamma and everything else, those little market moves inside of there, you're just not going to be able to collect the full premium. So if you get, I don't know why I started talking about collecting full premium. You're not going to get like a full double on this, because if it went from 14 to 28, that would be like over a 20% correction in the market. Okay. When you're doing this strategy, and I would look for it to move that $14, that's about a 10% correction in the market, you guys. So how often do you see a big 10% correction in the market? Well, we can say, well, we came really close in the last couple of days, but usually that hasn't happened. It happens maybe once or twice a year. So make sure you stick with the exit plan here on if you're 10 days in this strategy and it increases by 10%, look to get out of it, okay? I look at the 30% increase. If you can get if you have a higher risk tolerance, definitely you can look at a 50% increase in the premium, but I would not go any further than that, right? 30% is usually a real strong area. And like I said, it takes a long time for these straddles to usually come to fruition. The harder and smarter you work, the luckier you get. You're right, Ted. And as a matter of fact, you know, I always say people aren't really lucky. There's not somebody that's luckier than somebody else. There's somebody out there that you look at and say, that person's lucky because every time that person, you know, does a scratch off when I'm with him, he wins. Well, it's because the guy does a scratch off probably 3 or 4 times a day and you saw him do it once, right? The guy has created multiple opportunities to get lucky. You can't get lucky unless you step out multiple times, okay? So yes, more probabilities you have, the luckier it looks like you are. So great point, Ted. Hard work pays off, not luck. You're right. Hard work does pay off and not luck. I'll agree with that. All right, so your max profit is unlimited because it can go completely to infinity and beyond, right? It's not really, stick with our profit targets and write that down when you do it. All right, I got in for $14. I need to get out at most when it's $18 and what, 60 cents, I think is an increase of 30% off the top of my head. All right, so you would write that down. But, you know, if it gets, you're inside 20 days and you're at a 20% increase in this premium, so it's, you know, another, what is it, $3, so $17 in a couple of days, look to get out. All right, your max loss is the premium paid. Anytime you're doing a debit strategy, it's the premium you paid. Now we have 2 break evens. It's the underlying price plus the premium. So the underlying price, or the break even, is when the underlying price is equal to that long call strike plus the premium paid. So in our example, we had the 287 strike, right? And we paid $14. So when it's trading to the upside at 301, that's our break even. And to the downside, when it's trading 273, that's our break even. Now, if we looked at today on that, and that those numbers are at expiration, you guys. You can achieve that break even well before expiration because of volatility expansion and things of that nature, like we saw just recently. What was I going to look at? SPY. I don't remember why. SPY. So, the 174 or something like that. So you could see I got that move down to the 174, but I was profitable today. So that means at expiration, when it's at that area, you would be break even. Does that make sense? So I was profitable, even though it just came down to by the time when I got out, it was at my break even, but that was profit because it was well inside of it and I got the volatility expansion, right? All right, so here, this is when I threw it out to you guys. Let's look at a couple of stocks. You know, I did that SPY one as an example, but you guys can throw them out there. We need low implied volatility %. So we want to start down here and we can start looking at some of these. Like, let's just look at Target while you guys are throwing some in there. we've got volatility expansion. It's at 33. Another thing we can look at, it doesn't show it on this chart, but let's look at this one, because we can look at volatility expanding. When does volatility usually expand? Well, the market really sells off like we've seen recently, right? We get volatility to expand because people are buying puts. And when people buy puts with both hands, that means a lot. Then when they're buying with both hands, that means premiums are getting pumped up, which is what the VIX measures in order to determine volatility. It also measures buying of calls as well, but more so when you're buying puts, it has a tendency to kind of spike. So that being said, we want low implied volatility and the expectation of it expanding. So we know volatility expands going into binary events. You can see heading into this binary event, which is just an earnings. A binary event, you guys, is any major event that affects the underlying. So a drug stock could be a trial result for a new drug. Earnings is always a good one for stocks. FOMC for treasuries, when the Fed meets, spikes volatility. So when we're doing this strategy, if there is a volatility event or a binary event inside of it, we're okay with it. I'd like to be out of the strategy before that event, but heading into it, I don't mind that volatility is expanding. I bought premium, and premium goes up when volatility expands. Therefore, hey, go up all you want, right? Even if it doesn't move and it goes up, you're good. Okay. All right. So heading into a binary event, it's good. I would highly suggest getting out before that. All right, somebody else threw out FCX, right? So Freeport. We could buy a straddle in here. Now, keep in mind, we need like a 10% correction, but it's trading closest to 13, so I'm going to buy the 13 straddle. All right, and I paid about, I was going to say about 90 cents. So 90 cents. So my break even to the upside on the calls is when it's trading 13.90, and to the downside, it's when it's trading 12.10, right? So those are our break evens on both sides. We can look at it on the Analyze tab to see those same kind of things. It's a little bit easier for some people to see this on here, but you can see the break even to the downside should be right around, why is that 23? Oh, 12. Oh, it's point. Oh, it's reading something else. Sorry. So 12.10 to the downside, and then should be 13.90 to the upside is our break even. Now, another thing you can notice that when volatility starts to expand here, you can see in a different way. If you watch this purple line today, we entered this trade. We are pretty much at break even. We are a scratch, right? But if volatility starts expanding on us, oops, stock price, I don't want to go up. I want that to go back down to where we were. I don't remember exactly where it was. Let's just say it's right in the middle. So the stock price is right in the middle. Volatility starts to expand. So you'll see as we expand volatility, that purple line should actually be moving higher. You can see it creeping higher. That means that if I put that trade on right now at this price and volatility expanded, I would have already been at profitability. And vice versa, if I put that in an environment where the volatility is too high and we see volatility coming out of that, what it's doing to our premium is making our premiums shrink quickly. So you can see as we start going into negative territory, that purple line is going to start going into the negative. So if volatility started coming out quickly as right after we put this trade on, the market didn't move in either direction, the day didn't change, we didn't lose any theta, we can see how volatility would hurt us. So try and buy this in an environment where volatility is expanding. Another thing to think about is when you're buying options, you are buying volatility as well. Okay, you're buying volatility on the expansion. All right, that's what you really want to have happen, which is why I pound it like a dead horse that we need to buy premium in low volatility environments for that expansion. And that's what we're looking for with this particular one. All right, Colleen, did you get that one? The the volatility looks high for a straddle. Right now, volatility is going to be high, but down here in the teens, like you could look at Target, like Target at 30, the retailers have been getting hurt lately. Target took a slam, but it came from a really low implied volatility. Heading into earnings, we could expect volatility to continue to expand. So I'm not too concerned about, these stocks that are below 50 right here having volatility expand, because the option that I'm buying is likely going to have a binary event in it as well. Okay. So I think the volatility is going to continue to expand. All right. That makes sense. But don't do it if it's above 50, you guys, because if the market turns like on Nike or that's not Nike, XLE, if the market turns really quickly, we're going to see this volatility come out rather quickly as well. Okay. Does anybody else have any other examples? I'll go over one more with you guys real quick with SPY, because I bet we can probably get this close to delta neutral as possible. So we go through the steps. It's not going to work. It's above 50 or it's above 30. So I don't want to do it. So let's look at a different one. GTC. Let's look at AIG. So AIG, we can look at this. $50 wide. Closest is 10 cents. That's inside of 10 cents. That works. We're good there. You'll be able to see there's a lot of volume and open interest going on any given day. So that's good. That's why there's tight markets. They are one and the same, believe it or not. So we look at this one. Closest to is the 50 one, right? Closest strike, 50 is that strike. If we go back to the delta, we're going to be looking at 52 to 47. That's a lot closer to delta neutral, right? So we bought 52 deltas. We're long 52 deltas. We bought negative 47 deltas. So we're short 47 deltas total. All in all, we're slightly long 5 deltas. Okay, and that's good. That's fine. Our break even to the upside is when the AIG is trading $55.20 to the downside, 44.80. Okay. So pretty simple. Want volatility to expand, though. I showed you how that volatility expansion or contraction will help us, and that's exactly what happened in my SPY trade. Is I got that expansion and volatility and the directional move to boot. So it allowed me to get out in just a couple of days. The directional move definitely helped a lot, but I'm telling you this, even if the volatility or the directional move happened, this volatility came out, I probably wouldn't have had a 30% increase in my premium. Okay. All right. One last one I'm going to do for Ted. Oops. Because I think we might run out of time. May have one more. We'll see. So QQQs, first thing to look at is the volatility. I bet it has higher volatility though, Ted. 67. So this would be a time where I would be looking to sell premium, especially in the ETFs that are up in the 60s. So Ted, I'd probably skip out on that one. And the reason why is volatility is just way too high. I mean, I'm paying the top of the market for premium. Does that make sense? I just know looking at this implied volatility percent, it's the top of the market. Oh, and one thing I forgot to tell you guys. The reason why implied volatility percent is so important is because 27 volatility for QQQs doesn't tell me anything. 27 doesn't mean anything because I can look at Tesla, right? Tesla's at 100. What does that mean? It doesn't mean anything. We can look at the RUT, or let's look at all these ones up at the 100%. So we can look at Apple. It's up at 100%. It's up at 100 IV or 38 IV, 38 IV. We could look at GM. It's at 38 IV. Adobe, 41. Okay, so they're pretty close. 41. So all of those are a little bit different. Trying to find something that has something, in 27. All those numbers don't mean anything, you guys, because that is just telling us where the volatility is for that underlying. But we need to know, is this 41 high for Adobe? Yes, you can see it's at 100%. It is high for Adobe. But the way we figure out this math is we take in a numerator and a denominator. We're going to have a fraction here. So we have a sum in the numerator, which is the high, or where the current is now, minus the low, and then divide that sum by the high minus the low. And that's why we're getting 100%. So something that's down here, Twitter, it's trading at a 68. All right, we just saw those other ones were at 40. So is Twitter high? Well, it's not at 100%, but it's 64 minus the 30. So 64 minus 30, we have 34 in the numerator. In the denominator, we have, I got to have my glasses on. In the denominator, 77 minus 34 gives us about an 80%. So this is, right now, we're in the 80 percentile of where we've been in the past. And you can see Twitter heading into earnings has a tendency to continue to expand in volatility. Afterwards, it comes out. So if you're doing this strategy heading into an earnings event based on the fact that you're getting long volatility, don't ride it through, because you could have that outpaced move, but the volatility crush could make you not make money. So get out before that happens. But Twitter, we could expect volatility to expand going into that. Does that make sense? Like continue to expand. What would it be too risky to sell premium, or too risky to sell the straddle in QQQs? I would say it's probably a little risky to sell it right now. I'd wait for maybe a clearer bottom, because I don't think that today's market action gave us any indication of a bottom. So I'd wait for something like that to happen in order to settle when the market starts to settle down then, which it will. So I'm not going to that's why you haven't seen me sell any premiums today. I've been getting out all my long premium and stuff like that, and the strategies that work. I've been getting out of those on the volatility expansion. I haven't added any short premium strategies right now because I'm waiting for this whole thing to shake out a little bit. Does that answer your question, Ted? All right, good enough. All right, one thing I tell you guys, let the probabilities work themselves out. I mean, the higher the probabilities of success, obviously, the more successful you will be, right? And I teach how to increase your probabilities of success, just like that strategy that I did in SPY, you guys. And I talk about them in the daily market commentaries, which you get with this deal, two months for the price of one. I talk about a lot more in these daily market commentaries on a daily basis than I'm able to really do in the webinars to give you real life scenarios that I'm putting on as I see them. So you guys should really be trading with this knowledge. And we've added a ton of new archived webinars for this service. So make sure you check that out. Like I mentioned, you get the daily market commentaries. Every day I do one. They're usually about 10 to 15 minutes long. I try and keep them short, but I'm a little long-winded. But I go over all the economic data. I go over all the markets, what I think the markets are telling us. And then I go over all of my trades, when I get in them and when I get out of them, why I got into them, why I got out of them. All right. So the best way to become a better trader is to constantly learn. You guys have obviously done that by making the decision to attend this webinar. But wouldn't you say that just knowing how to create an option strategy like the straddle, you can go online and figure that out, is not enough to create consistent winners? I mean, just like I did with this one, and it is, probably the best example you could ever give, I suppose. But having said that, I set myself up for success by following my rules, getting into the straddle with low implied volatility. We got that expansion and the move. It worked out. So I teach just that, how to play the probabilities, how to trade the volatility. When the probabilities have gone against us, how to stay mechanical and increase our probabilities even further in our favor, all right? Which creates that alpha that everybody talks about, all right? So when you're using the right tools for the right situation, your more productive state of mind, you'll be able to put on more strategies. And ultimately, when you're able to do that, you create luck, right, you guys? Well, you create more opportunities, and that will build your confidence, and you will be on your own. All right. So we're offering this trial for you guys today. I suggest you guys take advantage of it. 2 months for the price of one. You get the daily market commentaries, access to over 50. And like I said, now it's probably close to 150 online access to the trading video archives. There's also these quick videos in there, 15 minutes long, that I go over the rules real quickly, just basically the first couple of steps just to get you on it. All right, what was the rule for an iron condor that he said? And you can watch that 15-minute video real quick to get yourself a refresher. So you'll get all of this stuff, like $1,500 value. You go through and you just check off the ones that you've watched, so you don't have to watch them again to realize you've already watched them. So you check it off, and it's instant feedback as to skip over that one the next time. So if you've learned anything at all from me today, click on it all. It's in the chat window. We've been going back and forth talking in the questions box. I put the link in the chat window over there so you can get that access over there. So if you've learned anything at all, like I said, from me today, you guys should be taking advantage of this and trading with this knowledge. So what do you say? Go ahead and click on that link. And finally, I just want to thank you guys all for attending. In later webinars, I'm going to be drilling down on different option components, trades I find when and where I find them appropriate. Here's also the link. You're going to have to pause the webinar in order to type this into your URL. Also, if you have any questions for us, reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. All right, so yeah, like I said, this link is in that chat window. Go ahead and click on that to get this and take advantage of that, you guys. I can't emphasize enough how much I think the importance is in watching those daily market commentaries for sure. All right, so I see a couple questions popped up maybe. So let me take a look at those. What is the indication that the market has bottomed, prices turning up? I look for that. Some of it I look for like the MACD turning around, but I usually look for it to come off of a support level. So for instance, let's just look at something like the E-mini S&Ps, for instance. You know, it popped down here. I actually think, you know, if it doesn't break below here, we're due for another move up. But, you know, I would probably wait for it to bounce off of one of these. This chart, this candle just doesn't look like a very strong indication as to a bottom. But I would look for something like, you know, the hammer doji or something like that. You know what the hammer looks like at the bottom. So like if you got, you know, an engulfing pattern, or if you got the hammer that looks like this, you know, big hammer like that at the bottom, or one that looked like this at the bottom, you know, of the move. I know that's not perfect, but you get the, you know, the chart like this and then confirmation or whatever. That's what I would look for. And I usually actually right now, like on tomorrow, if I got one of these, I'd probably be looking for that as a move higher. But I am a person that gets in before the market confirms. So, but that's because I take more risk, I think. Ted, thanks, Eric. Another great webinar. Appreciate it. To prospective members, this is the best $97 per month I've ever spent. You'll save much more money. Thank you, Ted. I appreciate that. Unsolicited endorsement, I suppose. All right. So basically, guys, 2 months for the price of one. Literally, if it saves you $45 on one trade, you've paid it off, right? And it will. You guys should allocate money towards education as well, because market moves like we just saw it, that cost of education is really a lot more expensive than this $97 I'm talking about, right? So that's about it. That's all I got for you guys. I hope everybody has a great weekend. And if you can't take that, take it easy. Appreciate it, Andrew. Oh, yeah, we got an Enjoyment Friday tomorrow, so that should be a fun one. The unemployment data. All right, guys, take care.